All right, we are working on a number of questions from the Garrison textbook in Chapter 10. We're looking at problem 10-18. We had started a little bit in class, but I think we'll complete it here. And we'll do 10-19, probably 10-21 as well, and possibly 10-26, which is the last one. So we begin by looking at the question as given, and so of course you can look at the question in your version of the textbook. I'll take a look at it here as well. So this is question number 19. We're required to compute the materials price variance for the plates purchased last month and a quantity variance for the plates used last month. So those are two different calculations. And then 2 says we're supposed to compute a labor rate variance and a labor efficiency variance. And in part B it says in most hospitals 3/4 of the workers in the lab are certified technician, 1/4 are assistants. In an effort to reduce costs, Clearwater Hospital employs only 1/2 certified technicians and 1/2 assistants. Would you recommend that this policy be continued? Explain. We're going to look at the labor rate variance and see what we see with regard to that. And then we'll compute the variable overhead spending and efficiency variance as it says here. And is there any relationship between the variable overhead efficiency variance, easy for me to say, is there any relationship between the variable overhead efficiency variance and the labor efficiency variance? Well, yes, there are, because in this case we actually have the overhead is used as the driver for the application of variable overhead. So we can see that right here, overhead cost is based on direct labor hours, and the average rate of variable overhead is $6 per hour. Average rate of fixed overhead, $8 per hour, and those are based on a 1250 hours per month denominator activity level. And then number 4 says we're supposed to compute the fixed overhead budget and volume variances. So there's a bunch of information about what actually happened in the last month, and so they perform a couple of different kinds of lab tests, and they require plates for those tests. There are smear and blood tests. Sounds a little gruesome for an accounting course, but I suppose makes sense. 2,700 smears and 900 blood tests were performed in the lab during the past month, and that's the month we're interested in. The administrator was puzzled because every month it's anyone's guess whether the lab will show a profit or a loss. Perhaps the only answer is to increase our lab fees again, and the controller says we can't do that. There are a lot of complaints about the last increase, particularly from the insurance companies and government health units. They're now paying only about 80% of what we bill. I'm beginning to think the problem is on the cost side, and to determine if the Clearwater lab costs are in line with those of other hospital labs, Goudreau, the administrator, has asked you to evaluate the costs for the past month. And Groves has given you a bunch of information to do that with, starting with the 2,700 smears and 900 blood tests. Small glass plates are used for those tests, and during the last month we purchased 16,000 plates at a cost of $38,400, and that is net of a 4% purchase discount. We can see a little bit later that it says that the plates are supposed to cost us $2.50 according to the standard costs for the averages, nationwide averages for hospital labs, which is proposed as being our standard cost for this example. So the plates cost $2.50 each on average for all of the labs in the nation. Each smear should require 0.3 hours of labor. Each blood test should require 0.6 hours to complete. And so those are the two different kinds of tests that we have. The average cost of labor time is $12 per hour. And as we read before, overhead cost is applied on that basis. What else do we know? A total of 2,000 of these plates were unused, so we apparently used 14,000. So 2,000 plates were unused at the end of the month. No plates were on hand at the beginning of the month, so we didn't have any opening inventory. We bought 16,000 and used 14,000 with 2,000 left at the end of the month. During the past month, we had 18 hours of labor time that were used in performing the tests. The cost of the labor was $18,450. The lab's actual variable overhead cost was $11,700, and their actual fixed overhead cost was $10,400. Okay, so you can either take a screen snap of that, or you can open it in your textbook. But let's see what we can do to actually do the calculations. So I've opened up a spreadsheet for us to work with, and here it is. So we are supposed to calculate, first of all, we should actually come up with a couple more tabs down here, but let's call this one 10-18, and then we'll see how we do on this one, and we'll perhaps use it again in the next couple of calculations, because we're calculating variance analysis there as well. Okay, had my sip of water, and here we go. So part one of the question was compute the materials price variance. So we're going to have sort of the actual amount here, and then the interim amount, and we'll call this one standard. And so we need, first of all, actual hours, or actual quantity, so AQ, times actual rate, or actual price, I suppose, for this one. Here we're going to have actual quantity, and we're going to multiply that by the standard price. And then over here we're going to have, of course, standard quantity and standard price. So from the information that we've been given, we know that the actual quantity was in terms of the plates. So we're talking about the quantity variance here, or the materials variances. So we actually used a total of 14,000 plates, but we're supposed to calculate based on the purchases. The question says compute the materials price variance for the plates purchased last month, and compute a materials quantity variance for the plates used last month. So purchases were 16,000, and we paid a total of $38,400. And so we can put in the 16,000 over here. We also know that the standard price is supposed to be $2.50. And the standard quantity is for each lab test we have 3, and we've performed a total of 2,700. So let's put some brackets in here. 2,700 plus 900 times 3. That's the amount that is supposed to take us for 3,600 tests at 3 each. So 10,800 was what we were supposed to use. We actually used 14,000, so we're going to have to do a little sub-calculation here, because we're going to be doing the calculation based on purchases here. And so we're going to call this purchase. Let's call it price variance. Purchases. And so that's simply the difference between this result, the actual, and the amount that we should have over here. So let's do a quick calculation. We're just going to multiply the 16,000 we purchased by the 2.5, which was supposed to be what it cost us, and that's 40,000. So that's actually a positive variance. It's a favorable variance. So if we go over here, we take the biggest number, 40,000, and we subtract the smaller number. Whoops. It's 1,600, and by comparing the two, we actually paid less than we were supposed to, so that's actually a favorable variance. So let's label that as very favorable. We're supposed to calculate a quantity variance as well. So the quantity variance is based on the amount used, and so here we need to calculate 14,000 units at 2.5, versus the standard quantity of 10,800 times 2.5. And so again, we just do the calculation of the two. Of course, if we were in class, I'd be asking you to do the calculation, but you don't have to because we have Excel to help us with that. So we're just multiplying the two numbers. 35,000 was what we used, the cost of what we used, and at the standard price. And we were only supposed to use 10,800. So that indicates something is amiss. And so let's first of all do the calculation. Again, we take the bigger number and subtract the smaller number, and then determine its character as favorable or unfavorable. Here, of course, we have an unfavorable variance. So we have an unfavorable quantity variance, and we have a favorable purchase price variance. Of course, that seems to be related to the 4% purchase discount, and we can actually calculate the actual price up here because we know we paid $38,400 for them, and the quantity was 16,000. So it actually cost us $2.40. So that would be a 10-cent discount, which is in line with the 4% purchase discount. So 4% of $2.50 is 10 cents per plate. So it seems that that's a reasonable result. So that's the first question. Then we got two. We're supposed to calculate a labor rate variance. We use the Canadian slash, well, I guess the Canadian spelling rather than the US spelling. Labor variances. All right. So the first one, once again, we're taking the actual hours and the actual rate, and the interim calculation is the actual hours times the standard rate, and the standard, of course, is standard hours times the standard rate. So once again, we do the calculation with the actual information. We are given the information that we used 1,800 hours of lab time, and it cost us $18,450 in total. So again, we can calculate the average just to see by taking the dollars. The $18,450 is dollars, and the 1,800 is direct labor hours. So it's $10.25 per direct labor hour. So our actual hours, once again, is 1,800. Our standard rate, we're supposed to be paying $12 per hour, according to the information under labor. And so we can calculate the rate per hour times the number of hours we actually used. It should have cost us $12. It only cost us $10.25. And of course, that's related to the fact that we're using more assistants and fewer certified technicians than the standard. And so the standard is set based on the average using 3/4 certified technician and 1/4 technicians assistants. So part B of the question says, in most hospitals, 3/4 of the workers in the lab are certified and 1/4 are assistants, but we're using half and half. So we're using substantially more assistants and substantially fewer certified technicians, and it seems that we're paying less per hour, which is reflective of the savings that we would pay for less skilled workers. On the other hand, it's taking us more hours. The actual number of hours that we worked is 1,800. It should take us 0.3 hours for all of the smear tests, of which there were 2,700, plus 0.6 hours for every one of our blood tests, of which there were 900. So if we do that math, 1,350 is the hours it should have taken us at a price of $12. And so once again, we can do the math in Excel. Should have cost us $16,200 for that volume of plates. So it cost us substantially more than that, we see. And so the answer to part B looks like it is that we're saving money on the wages, but it's taking us substantially more time to complete the tests, and because of that excess in time, the rate savings, the rate variance, the favorable rate variance that we see on this side is more than swamped by the unfavorable quantity variance on the other side, or efficiency variance. So let's calculate the rate variance. So the rate variance is going to be, once again, the biggest number minus the smallest number, 3150, and we saved money, so that's a favorable rate variance. On the other hand, over here, we have our efficiency variance. And once again, we take the bigger number. Whoops. Take the bigger number minus the smaller number. 5,400, and that's an unfavorable variance because we spent more than we expect to. And of course, when we add these up, our total spending variance, labor spending variance, is, we add the bigger number. I guess we're just taking the total difference between the standard, bigger of those two numbers. Whoops, that's not the bigger of those numbers. Let's try this again. The bigger of the two numbers, 18,450, is larger than 16,200. We'd end up with the same difference, of course, either way, but it's just we want to characterize it as unfavorable or favorable, and so we don't actually have a sign. It's like debits and credits. There's no actual sign attached to them. It's just the fact that it's a debit indicates what treatment is appropriate. So here we actually have spent more than we wanted to, and that's an unfavorable variance. So the first part of 2 was compute the labor rate variance and the labor efficiency variance. We've got a 3150 favorable rate variance, but a 5400 unfavorable efficiency variance. The lack of efficiency, despite the lower cost of labor, means that we're actually spending more than we should have. We've got a 2250 unfavorable overall variance for our labor variances. Number 3, question number 3, or part 3 of this question, asks us to calculate the variable overhead, spending, and efficiency variances. Now, spending variance is a term that we use for the rate variance for variable overhead. So once again, it's based on hours of work, and we have actual hours and standard rate. This is the predetermined rate. Standard rate, standard hours. Standard hours, of course, are the same as because we're using the labor variance as our driver. Our actual hours are also the same. And it says that our total overhead cost was actually 11,700. So we can calculate the average for whatever it's worth. $6.50. The application rate for most of the hospitals nationwide, the average nationwide rate was $6 per hour. So we can again do the calculation by multiplying that out. Whoops, going the wrong direction. And again, 10,800 is the sort of interim measure, which is our actual hours spent times the standard application rate. The standard hours 1350 at 6 is the actual the expected amount that we would take for the same number of tests. As you recall, if you see up here, we calculated 0.3 times 2,700 smear tests plus 0.6 hours times 900 blood tests. That gave us the 1350. So for the plates that we have used for tests, or the plates that we should have used for the tests, should have cost us $8,100, or 8,100 hours of time. No, it should have cost us $8,100 for variable overhead, and it actually cost us 11,700. Partly due to a spending variance. So the spending variance is going to be this one, and it's going to be the bigger of the two numbers. Whoops, that's not the bigger of the two numbers. That is the bigger of the two numbers. And that, of course, is unfavorable because we're spending more than we wanted to. And then the efficiency variance is on this side. And we take the larger of the two numbers once again, subtract the smaller of the two numbers, and this one is actually also unfavorable. So we actually have two problems here. One is that the actual amount we're spending is higher than the amount we should be spending for the actual hours that is taking. So the rate of 6.5 per hour is higher than the standard rate for hospitals in the nationwide sample. And we also see that the efficiency variance is, well, it's driven by the same difference as we have in the labor variance up here. Because we're inefficient in terms of the amount of hours we spend doing tests, it results in any inefficient or unfavorable variance in the variable overhead variance as well. So our total overhead variance, total variable overhead variance, is the total of those two. The difference between the larger number and the smaller number, and it's unfavorable because both parts are unfavorable. So it asks us the question, is there any relationship between the variable overhead efficiency variance and the labor efficiency variance? Yes, and that's because they're both driven by the labor time that was used. So because there's an unfavorable labor efficiency variance and we're using labor hours to calculate the variable overhead efficiency variance, both of them will always be the same. Proportionate to one another, but always the same direction. And finally, we're supposed to calculate the fixed overhead budget and volume variances. And so that's part 4 of the question. And so, oops, go on fixed overhead. And the fixed overhead budget variance is just the actual fixed amount compared to the budgeted fixed overhead cost. And the budgeted fixed overhead cost is based on the 1250 denominator level of activity times the 80. So let's start here. I'm going to put the actual here and the budget. And this is not a flex budget, this is the budgeted amount, and then the applied. Okay, for some reason I've got a different number of columns here. Let's go budgeted. And so the actual, the only thing we know is the actual fixed overhead cost was $10,400, and the budgeted amount would be 1,250 hours at the rate of $8 per hour. And so that, whoops, should be 10,000. So in the overhead paragraph referring to the nationwide averages, it says that the average rate of fixed overhead is $8 per hour, and these rates are based on a denominator activity level of 1,250 hours per month. Of course, the actual hours were 1,350, which we can see above in both the other variance calculations, and we can calculate the applied amount. So over here we have the spending variance, or rather, sorry, I'm confusing variable overhead. This is the budget variance, and over here we'll have the volume variance. And of course, it's so called because the only difference is the number of hours that we should have used for this number of tests is different from the predetermined rate that we used to do the calculation. So we budgeted for 10,000 hours, and then we applied it for an extra 100 hours more than we expected at the beginning of the year. So once again, let's do the calculation. Take the bigger of the two numbers minus the smaller of the two numbers, and then determine its character. In this case, we spent more, that's unfavorable. Once again, volume variance, take the bigger of the two numbers, and that is that's actually favorable. So the total fixed overhead variance would be the difference between the two endpoints, which is the 10,800 minus the 10,400. And of course we spent less, so that's slightly favorable. But does it really mean anything? No, we budgeted for $10,000. We spent 10,400, so something was not budgeted for properly. But the difference between the budgeted and applied is essentially the under application that we saw when we talked about job process costing. The same idea. We used 1350 as our standard hours for the amount of work we did, and at the standard rate of $8 per hour, this is just a difference between the expectation and the predetermined amount of hours and the actual number of hours that we used to apply the overhead variances. So I'm not sure if I can get that all on the screen. I don't think I can, but that is the first question, 10-18. So I'm just going to copy that, and we may be able to use it to answer the next question as well. So let's I'll call it 10. Oh, you can't see this, right? Alright. So down here at the bottom, this is 10-18, which we just finished, and 10-19 is our next question. So we have a bunch of information here that we may or may not use, but we'll replace it as we go along. But first we need to see what the question says. I just discovered that the question we were just working on was actually problem 10-19, and we were supposed to do 10-18 first. So we'll actually use the template we just worked through to calculate the results for problem 10-18, which is now shown in your screen. And so this one we're producing ingots, and I believe we actually did the first couple of questions in class. So we actually did A and B, but I'll briefly work through those as well. And then, required part 1, A and B, we did in class. Don't think we did the manufacturing overhead spending and efficiency variances, so we'll fill that in the same way as we just finished in problem 10-19. And then summarizing the variance that we computed in one above, it'll show us the net overall favorable or unfavorable variance for the month of October. So we'll add all of that up, and we'll see that it actually explains the difference between the variable expenses here, between those two numbers, the budgeted and actual amount for variable expenses. And then it says pick out the two most significant variances you computed in one above and explain to Gosnell the possible causes for these variances. Once again, quick review. Gosnell is shocked. Shocked, I say, to see the poor results for the month, particularly since sales were exactly as budgeted. She stated, I sure hope the plant has a standard costing system in operation. If it doesn't, I won't have the slightest idea where to start looking for the problem. So indeed we do use a standard costing system. So what should cost us to produce an ingot is $8.17 based on 2 kilograms at $1.25 per kilogram, standard cost of $2.50 for materials, 54 hours, $10 per hour, $5.40 for labor, 0.27 machine hours, as it says here, is based on machine hours. 0.27 machine hours should cost us $1 per hour, or 27 cents per ingot, so it should cost us $8.17 to produce an ingot. And of course the ingot costs are all included in the variable cost of goods sold. So the difference between the 40,000 and the 45,455 is based on direct materials variances, direct labor variances, and variable manufacturing overhead variances. We see the variable selling expenses are the same as expected because they're related to the sales revenue, presumably. So Gosnell has determined that during October the plant produced 2,500 ingots and incurred the following actual costs. So the actual costs are listed below here. 6,300 actual kilograms of materials at a cost of $1.50 per kilogram. That's kind of bad news because we wanted to spend $1.25. We spent $1.50. There were no raw materials in inventory at the beginning of the month, so we don't have to worry about the difference between production and sales. It says we use 4,900 kilograms of materials in production. Finished goods and work in process inventories are insignificant, can be ignored, so we're not going to worry about those. Then it says, for the purposes of the labor variance, we worked 800 actual hours at a cost of actually 9.5 per hour, and then incurred a total variable manufacturing overhead cost of $10.80 for the month. A total of 900 machine hours was recorded, so we use that based on the standard rate to calculate the variances. It is the company's policy to close all variances to cost of goods sold on a monthly basis. So that is, of course, the reason for the difference between the variable cost of goods sold we see up here at 54.55 should be the total of our all of our variances that go into variable cost of goods sold. So let's see how we do. Once again, you'll have to either take a screen snap of this information or look it up in your own textbook. So I'll leave that there for a moment and then move down so you can see the required portion. And there we have the required portion. So you can take a screen snap of any of those as you like and then hold them aside to see what numbers we're working with. Okay, we're back to the spreadsheet. This is the 10-19. This is the one we just calculated. So that was the second one in our list. Now let's go back to the first one in our list, which is 10-18. We'll replace this information with other information and determine what the actual quantity should have been. And here we purchased 6,300 kilograms of material at a cost of $1.50 per kilogram. So 6,300 is the actual quantity, and the cost is $1.50. So here we can actually do the calculation as $94.50. And then the interim, the sort of middle number, is the 6,300 actual quantity times the standard price, which is supposed to be $1.25. It's not 1.25, it's 1.25. So the standard price, once again, $1.25. And to make 2,500 ingots, those 2,500 ingots should have cost us 2 kilograms each, according to the standard cost. And then we do the math. Oops. To show that 62.50 is the standard quantity to produce 2,500 ingots. Now here we don't actually have a difference between purchases and used, as we had in the previous problem. So we can just pick up the same. We can just copy these three and just paste them in there. So we also need to take these three and copy them and paste them here as well. So we have a 1575 negative number here. That's the wrong direction, and that's because we haven't done our calculation yet. We have that number minus that number, the larger number minus the smaller number. And in this case it's unfavorable because we actually spent more. We spent $1.50 per ingot's worth of $1.50 per kilogram of raw materials, and our standard cost said it should be $1.25. So we're actually spending a little bit more. But on the other hand, we have $16.25 due to the fact we used more actual material than we were supposed to. No, I'm lying to you. I'm just reading the second paragraph. Gosnell has determined that during October the plant produced 25 ingots and incurred the following costs. So this is the price variance for purchases. And let me just slide a couple more lines in here because we actually do have to do another calculation. So based on purchases, the price variance is $15.75 unfavorable, and then the quantity used is different. It's actually given in paragraph B as 4,900, and so in this case it's actually favorable, which of course is the case because I have them backwards. So once again, we take the difference between the big number and the small number, and then we determine its character. We spent a little bit less than we expected to, so the variance is favorable. We spent 61.25 when standard prices said we should have spent 62.50. So 4,900 kilograms were used to produce the product, the ingots, and we're supposed to use 5,000, so we saved a little bit on raw materials used, but it cost us a little bit more. So it might have been that we got better quality material, and as a result we're able to use less of it to produce the same number of ingots. We're not given a lot of information about that, but that would be one of the potential reasons for a favorable quantity variance and an unfavorable purchase price variance. Alright, moving along to the labor variances. The labor variances, we are supposed to be taking 0.54 hours. So once again, we'll do the calculation over here. It should be 0.54 hours times the number of ingots, 2,500 ingots, and that should be at $10 an hour, so 13,500. The actual number of hours we worked is given to us as 1,800, so we'll just leave that as 1,800, and of course that's at $10 per hour, not $1 per hour, but $10 per hour. And then the information tells us the 1,800 we're at $9.50 per hour, so let's do the math. That costs us 17,100. Now in this case, we see that the 18,000 minus the 17,100 is actually a favorable variance. We spend a little bit less per hour than we expected to. And on the efficiency side, we actually used a little less labor than we expected to. So we expected to use $18,000 worth of labor at $10 per hour, and we actually only used $13.50. So, the other way around. This is unfavorable. We're supposed to use $13.50, and we actually used $1,800. So it could have been the cheaper hours were less skilled laborers, so they spent more time squeezing out 2,500 ingots from the raw materials. Anyway, $13.50 is the standard hours, $1,800 is the actual hours. So we had an efficiency variance which was unfavorable for 4,500, a rate variance which was favorable for 900. Overall, though, bad news, we have a 3,600 unfavorable variance, and that of course is just the difference between the two endpoints, the 13,500 and the 17,100. We spent much more than we expected to spend. That's 3,600. Alright, moving down to variable overhead. Here we're talking about machine hours, actual machine hours as opposed to direct labor hours, as we were in the 10-19 question that we just looked at. The actual manufacturing overhead was 1080. So we can just plug that in here and take it out of there. Alright, so based on our standard cost card, the each ingot should have cost us, made 2,500 ingots, should have cost us 0.27 hours. And it should have cost us $1 per hour. So $675 is what variable overhead should have cost us, according to our standard cost for manufacturing one ingot. The standard price was one, and the actual hours was 900. So it actually cost us 900. And so if we want to do the calculation over here, 900 machine hours, we can calculate the average as divided by, it's $1.20. So variable overhead there was a little bit of a spending issue. We have 180 unfavorable for the spending side. We also have 225 unfavorable on the efficiency side. So overall, our total variable overhead variance was unfavorable by 405. Okay, so that's got to renumber things here. So this is 1A, A in this question. Down here we got 2, it's actually 1B. And here we have 1C. So we can actually get rid of the fixed overhead variances because they never asked us about fixed overhead variances in this one. So let's just grab all of those and we'll delete them all. There, they're gone. Okay, so we have the answers to part 1 shown up here. And the next question says, summarize the variances you computed in one above by showing the net overall favorable or unfavorable variance for October and what impact did this figure have on the company's income statement. Well, let's just summarize them over here. We'll call this 2 over here. And here we have how do I want to do this? I'll just summarize them. So we've got this one over here, which is unfavorable. And so we probably should make that negative. So let's change the sign to negative. And then this one over here, the quantity variance, that one is 125 favorable. So we can just leave that with the favorable sign. It's favorable. And then we have a favorable variance and an unfavorable variance, and an unfavorable variance, and an unfavorable variance, because the next one is the rate variance, which was favorable. And here we have the unfavorable efficiency variance, and here we have the unfavorable spending variance, and here we have the unfavorable efficiency variance. And so now we can use Excel. Let's add those up, and we should probably do the accounting thing and actually put some borders around it so that we know it's a subtotal. So here we go. And so it's negative, which means it's actually an unfavorable variance. Now we've kind of moved from convention here because we are using negative and positive signs, but that's so that we can actually tie the numbers in. So with regard to spending, the budget says the budgeted variable cost of goods sold, the budgeted amount is different from the actual amount. So the budgeted amount, as we saw before, was 40,000, and the actual amount that we spent was 45,455. And of course, if we take the difference between those, we also end up with minus 54.55, and that is the impact on our financial statements, which was requested. The question asks us to summarize the variances you computed in number 1 above, which we've done right here, and shows the net favorable or unfavorable variance for October, 54.55 unfavorable. The impact that it had was the actual cost of goods sold was higher than budgeted by 54.55. It says pick out the 2 most significant variances that you computed in 1 above and explain to Gosnell possible causes for these variances. So here we have 1575 unfavorable, which is the price variances based on the amount purchased. So this is the cost of purchasing raw materials, 6,300 kilograms of materials at an extra 25 cents per kilogram. So there's a number of reasons that that could have changed. It could have been just that the general price in the market changed. It could be that our purchasing manager is getting a kickback, and that would be bad. But it could be that our standard cost is wrong as well. It could be that the prices in the market have changed from $1.25 up to $1.50, and we hadn't adjusted the standard cost to reflect that change in prices. If we're making ingots of metal, which presumably is what ingots are, metal prices do vary substantially. So the raw materials, the ore that we use to smelt our kilograms of materials, into ingot form would change price fairly commonly. So we might actually want to develop a flexible budget of some sort based on market standards, but that's beyond the scope of this particular question. So that was 10-18. We did 10-19 first, and then we did 10-18 next. So we have a couple more problems to do. We've got 10-20, 10-21, and 10-26. And so we'll do those next. So I think we'll go back to the 10-19, and I'll copy that spreadsheet to use for our next example, which is 10-21. All right. So here's the question for problem 10-21. We're supposed to compute the predetermined overhead rate for the year and break it down into variable and fixed cost elements. So we'll need to know the predetermined overhead amount and the predetermined overhead application base, and we'll calculate that into variable and fixed cost elements. And then we'll show how the 92,000 applied cost, or 92,000 pound applied cost figure is arrived at. And then 3, analyze the $4,500 underapplied overhead figure in terms of the variable overhead spending and efficiency variances and the fixed overhead budget and volume variances, and explain the meaning of each variance from 3 above. So that's what work we're supposed to be doing. Now, the Scottish firm of Cullen and McNeil produced a single product. They use a standard costing system to control costs. Manufacturing overhead is applied to production on the basis of standard machine hours. So that's the application base that we're going to use. Scottish currency is the British pound. Well, for a while there it was the euro. Now it's going to be back to being the pound again. So I guess that's somewhat accurate. According to the company's flexible budget, the following overhead costs should be incurred at an activity level of 18,000 machine hours, which was the denominator activity level chosen for the year. So, given that these were the projected or predetermined amount, pounds or currency units, for variable and manufacturing overhead costs, we can use those by dividing them by 18,000 machine hours to determine the rates, which is the answer for part 1. Then part B, or part 2 rather, part 2, how the 92,000 applied cost figure was arrived at. Well, we actually have machine hours of 15,000, and 16,000 is the standard machine hours allowed. So the actual machine hours worked would be the basis for application. So it should be 15,000 times the rates we determined in part 1, and that would give us the applied version of costs, or the applied amount of the costs. And we can see that the actual costs are just the total of the actual variable costs plus the actual fixed manufacturing overhead cost. So that's the actual cost coming in on the debit side. The applied costs going out on the credit side are 15,000 hours times the rate that we have here. And it says to analyze the $4,500 difference. It's the difference between the actual costs and the applied costs. And we'll see that that will be explained by the 4 different variances that they list here. And we'll talk briefly about what the meaning of each of those variances is. So let's get started. We don't have any materials variances, so we can get rid of all of those and say goodbye to them all the way down to here. And then we have variable overhead, and this is part 1. Actually, that's part, when we get there, that will be part 3. Alright, so we may need to come up with more space above here, so let's just quickly give ourselves some space. 10 rows should be enough, I hope. Alright, so question 1. Compute the predetermined overhead rate. Well, the variable rate is going to be the variable manufacturing overhead cost of 31,500. So let's go, let's call it variable rate. Let's type it all again. Variable rate, predetermined overhead rate, and then over here we'll do the fixed rate, predetermined overhead rate. And so we're going to do cost divided by base in machine hours, and that'll give us the rate. So we start with the cost. 31,500 was our expected variable cost at 18,000 machine hours, and our fixed costs were 72,000, and that's in dollars. And the machine hours, of course, were 18,000 for both of them. So that gives us the rate of equal to the top number divided by the bottom number, or $1.75 per variable. I guess we can probably just copy this across, or we can just do put that there, and then we'll calculate the dollars on the top divided by the machine hours on the bottom, and give us $4 per hour as our fixed overhead rate. So that answers the first part. Compute the overhead rate, variable and fixed. And so then 2 is show how the applied cost figure in manufacturing overhead cost, or the manufacturing overhead account, was computed. It should just be the actual machine hours worked, so that's the basis of application. So it should be equal 15,000 times 1.75, oops, plus 4, and let me, if I put an apostrophe here, you'll actually be able to see it. So let's copy that, and then put it down here, and then take the apostrophe out. Okay, so that's not the number we're looking for. No, it should be the standard machine hours allowed for that volume production. So it should be 16,000, not, there we go, that's the one we're looking for. So it should be 16,000 because it's based on standard machine hours allowed. So, and we know that because the question says that they use a standard costing system to help control costs. So for the volume of activity, the volume of whatever product it is that we produce at Cullen and McNeil, for the volume that we actually produced, it should have taken us 16,000 standard machine hours, so that would be the basis for the application to this process. So it should be $92,000 of applied cost based on the standard machine hours allowed for this level of production. Maybe call it the actual level of production. Okay, so that's 1, 2, 3. Now we're supposed to add up all of the variances, so let's do that once again over to the side here. And we have an unfavorable variance for the spending variance, and we have a favorable an unfavorable variance for the efficiency variances. Oh boy, but we haven't done the calculation yet. Sorry. Let's step back here again. Variable overhead efficiency variance, variable overhead spending and efficiency variances. The actual number of hours was 15,000, and the actual number of hours was 15,000, and the actual rate, we actually spent 26,500 pounds, and so we can calculate the average, which I think is what this is, 176, as opposed to the standard rate, which would have been $1.75, which we calculated above, and the standard hours would have been 16,000 at the $1.75 rate that we calculated above. So that gives us a 250 unfavorable variance, and so we're taking the 26,500 minus the 26,250, and we're spending more than we expected to, so that is an unfavorable variance. However, the efficiency variance is the other direction, so we need to recalculate that one. So we can't have a negative sign. We just need to do the calculation, and in this case the standard is more than the interim amount, or the standard rate applied to the actual number of hours, and so this is actually a favorable variance, and so we can see there's a negative sign in that one as well. So once again we need to calculate the variance by taking the larger of the two numbers. The larger of those two numbers is that one. We subtract that one, and of course we spent less than we expected, so that is a favorable variance, which makes sense because we have a 1,750 favorable variance here and a 250 unfavorable variance. The net of the two is a 1,500 favorable variance. Now let's do the same for the fixed overhead. Now of course all of the machine hours have to be the same for all of those, but the rates of course don't. So the rates are based on our calculation. The standard rate is $4, and the actual amount that we spent was 70,000 pounds, and so we can calculate the average just for comparative purposes. Excuse me. So it cost us $4.67 when it should have cost us $4. So here we have 10,000 unfavorable something looks out of whack here. Our budgeted amount would have been based on the 18,000, I believe, right? So the budget amount should have been 18 at 4, or 72,000. The actual fifth cost is 77,000, and so the actual well, we actually don't have these numbers. Don't make any sense. So let's just take off the 70,000 is what we actually spent. There's no basis for, like, there's no application rate or rate that is applied to the actual spending. So 70,000 is just the amount of checks we wrote, so there's really nothing to say beyond that. So 18,000 is the budgeted fixed overhead cost, or 18,000 times 4, or 72,000, and that agrees with what we calculated up here, what we see up here as the expected cost. The actual application was only over 16,000 hours, the standard machine hours allowed for that level of production. So that is the 92,000. So if we take the 64 here plus the 28 there, that gives us the 92,000 that we see up here as the applied amount. Everybody see what I'm saying? 64 plus 28 is 92,000, and that's just the application of a different number of hours than we actually used. So that begs the question whether I've got my actual hours are 26,500, 26,250. That looks good, and 28,1750. Okay, good. So now, given that we have a negative number there, we're going to have to recalculate that one. So we'll pick the bigger of the two numbers, that one, and subtract the smaller of the two numbers. And we're spending less, so that's actually a favorable variance. And this one, if we take the bigger of the two numbers, 72,000, and subtract the smaller of the two numbers, 64,000, we're actually spending more than we expected to, so that's an unfavorable variance. And we can check it by comparing the larger of the two endpoints to the smaller of the two endpoints, and we actually spent more than we expected to, so that's an unfavorable variance, which makes sense because we have an 8,000 unfavorable variance offset by a 2,000 favorable variance for a total favorable or unfavorable variance of 6,000. So now the question is, how do we determine the 4,500 of this question 3, Analyze the 4,500 pound underapplied overhead figure in terms of the variable overhead spending and efficiency variances and the fixed overhead budget and volume variances. So if we just take the 6,000 unfavorable here and the 1,500 favorable here, 6,000 minus 1,500 works out to 4,500, and that's an over-applied amount, or an under-applied amount, because we've applied 96,000, or we've applied 92,000. We've applied this number. And as we said, that's the total of that number plus that number. Whoops. That number, let's do control, plus that number. Works out to 92,000. And the actual, of course, is the difference between, where's the total of this 26,500 plus the 70,000 here, or 96,500. So the difference is simply the total of the two. So if we were to put 4 here, 4, we would be able to write, oh, actually, it's not 4, it's 3. Total variance equals, and then we'll just go minus that plus, oops, I knew I was going to do that, plus that equals that, and then we'll put an equal sign here, and then we'll add the two together. Equal minus that number plus that number, and that gives us our 4,500 under applied. So to fix under applied, of course, we're going to debit cost of goods sold and credit manufacturing overhead for 4,500 and 4,500. Then the final part of the question here is to explain each of those variances. The variable overhead spending variance means that we spent more than we expected to spend. So we budgeted for 26,250. At the actual number of machine hours we experienced, so 15,000 at $1.75 should have cost us 26,250, since it's variable and related to the number of machine hours. It actually cost us 26,500 for that number of machine hours. So that's the spending variance. The efficiency variance is the difference between the standard machine hours for the level of production of whatever it is we're producing for how many of our units we've produced, and the actual hours that we spent, actual machine hours. So we actually were a little bit more efficient than we expected to be, but it cost us a little bit more. So we have a positive, favorable efficiency variance and an unfavorable spending variance, giving us a net overall variable overhead variance of 1,500. And then, of course, the budget variance is just the difference between the budgeted fixed overhead and what we actually spent. So we saved $2,000 on our fixed overhead costs, whatever those might have been. And the application that we did into our manufacturing overhead standard costs was $64,000. So that explains those variances. So the budget variance is simply the difference between our budgeted fixed cost and the actual fixed cost. The volume variance is just a difference between the denominator activity that was used in predetermined overhead rate calculation and predetermined overhead rate application. All right, we have one more question to do, and that is question number 26. So let me just add a blank canvas to that one. Oh, how did I do that? Let's just, what I tried to do is just hit the plus. There we go, that's what I'm looking for. 10-21. Here we're actually asked to do a different kind of calculation, so I didn't just copy the sheet. Whoops, no, it's 10-26. I can see why the program is complaining. All right, so let's take a look at the question once again. So that was 21 we just looked at. 26 is way down here. This is a flexible budget and overhead performance report. And so we're supposed to prepare an overhead performance report for the month of March, including both variable and fixed costs, and show the spending variance in the report. So we're just calculating the difference between the actual and the budgeted amount. And then we're supposed to calculate what additional information would you need to compute an overhead efficiency variance for the department. And of course we would need to know the standard hours allowed for the 9,000 units that we produced during March. So a little information here. Our cost formula gives us the rate per predetermined. These are the predetermined overhead rates for different kinds of overhead cost. And we have depreciation, which is probably because it says 32,000 per month, it's probably a fixed cost. Indirect labor, 120,000 per month is probably fixed cost, and the 60 cents per machine hour, because it's related to machine hour, we know that that's a variable cost. Also the lubricants, $1 per machine hour is the variable portion, 8,000 for the fixed portion, and we're supposed to be setting the overhead analysis up separately for those two. It says that our company, Groschel Company, no idea whatsoever how to pronounce that. So if you pronounce it differently, that's your prerogative. It says they've had great difficulty in controlling their manufacturing overhead costs, and so the president thought that we should use a flexible budget for them. So we're supposed to he's hired you and me, presumably. He's hired us to implement this budgeting program in their company. So you develop the following cost formulas based on some effort, get those engineers and accountants together and figure out what the cost should be. And your normal operating range is 10,000 to 20,000 machine hours per month. So if it's more than that, we might have a problem applying it, but it turns out that we worked 18,000 machine hours, which is within the relevant range, and we produced 9,000 units of product with those 18,000 units of machine hours. The actual overhead costs were listed here. So basically we're going to compare these to what we should have had for the cost based on these formulas. So we're checking to see whether our formula actually works. And that's essentially what we're calculating with the spending variance, which we're trying to figure out how much it should have cost us to run a machine for 18,000 hours, and comparing that to what it actually cost us to run machines for 18,000 hours. So let's get started. We have some information about the let me just bring back the question for a second. It says fixed costs had no budget variances, so the fixed costs were presumably correct. The department had originally been budgeted to work 20,000 machine hours during March. So the budgeted amount would have been based on 20,000 machine hours. And so let's get started. So we have a number of different kinds of overhead. So we've got some variable overhead. Variable overhead. That's right, variable overhead. And we have some fixed overhead. And the variable overhead includes utilities, lubricants, machine setup, and indirect labor. And the fixed overhead includes lubricants. Oops, not sure why I spelled that with a W. Lubricants. And then we have some indirect labor. And we have some depreciation. Alright, so we're going to put in the cost per machine hour here. And for utilities, it's 0.7. For lubricants, it's 1. For machine setup, it's 0.2. And for indirect labor, it's 0.6. 0.6. 0.6. 0.6. And so then we want the actual costs. So let's put that right here. Actual. And we just got the numbers from the list. We're going to do some allocation with the lubricants. The machine setup, 4,800. Okay, so with the lubricants, we spent 24,500. Let's do the calculation this way. 24,500. But we know that the amount allocated for fixed is 8,000. So we have 8,000 here. Okay, well, flexible budget. At 18,000 machine hours. So we take 18,000 and multiply it by this column over here, and we can just fill that all the way down. Indirect labor also has a fixed portion, so it's 60 cents per machine hour, and it says that our total spending was 132,500, but the fixed portion was 120,000 of that. Okay, so down here in the lubricants we have 8,000, whoops, and 8,000 because there were no fixed overhead variances. The lubricants, the indirect labor was 120,000 and 120,000, and the depreciation, which the accountants told us, 32,000 and 32,000. So so we need to make this a little less wide. I thought I deducted that up there. Okay. So now let's just calculate the variance, the spending variance. Let's do it this way: spending variance. So we're just going to take the larger of the two numbers minus the smaller of the two numbers. So that one, and then that'll work for this one. Let's go that way. Okay, so in these ones we actually have them going the wrong direction. So here we have the larger of the two numbers minus the smaller of the two numbers, and we can calculate that one by dragging it down here. Okay, so these ones we spent less than budget, so that's favorable. Spent less than budget, that's favorable. Spent more than budget, it's unfavorable. Spent more than budget, it's unfavorable. So let's add those up. Okay, here let's do the old accountant subtotal, line above, line below. Did we get that? No, we didn't get that. We want the bottom border as well. There we go. And we're just going to take the sum. And then I'm going to drag that all the way across. And get rid of this one. I'm going to copy a blank cell. And paste it in there. We're good. Okay, so we have a $5,000 total variance, but that's not right. So why is that not right? Because we're supposed to be taking the difference between the two. Take the bigger of the two numbers minus the smaller of the two numbers, and that is the actual spending is above the flexible budget, so that's unfavorable. Now we can quickly check to see whether this makes sense. If we made these positive numbers and these two negative numbers, we have 2,900 unfavorable minus 2,100 favorable, which is a difference of 800 unfavorable. Of course, all of these ones have zero variance. So, well, let's just copy that down here. Get rid of this top one. Of course, none of them are actually variances, so we can get rid of all of those. So there's no variance, no spending variance for fixed overhead because they were all the same as budget. And so our total overhead cost, we should copy some totals down here as well. And so let's drag that over here. Oops. Okay, good. So then we have our total overhead, which is just going to be the total of the variable overhead plus the fixed overhead, and we should put a double underline under that because we're accountants and we like to indicate totals with bottom double borders, so we can calculate, we can copy that and put it there and then put it there. And this is unfavorable, just take it from the top. Okay, so that gives us our performance report. It looks like we spent more on utilities, or we spent less on utilities and lubricants for the variable portion than we expected to, and we spent more for machine setup, which means that machine setup would be caused by changing the production run from one product to another. So it looks like we may have had more frequent setups than we expected to. Indirect labor would be things like maintenance staff and custodial staff, and so we spent a little bit more than we expected there as well. So this is the spending variance. This is the difference between what we budgeted to spend and what we actually spent. Part of their problem was due to the fact that they were using a different predetermined level for machine hours. So the predetermined level was 20,000 machine hours. That's how they calculated these cost per hour figures. And so if they were just using a budget based on the 20,000 machine hours, they would expect to have a much, well, 20,000 machine hours should give them a higher cost than actual. So in that case, they would have a much lower actual than they would expect. We can see that from this analysis that a big part of the difference between the budgeted amount for variable overhead and the actual the flexible budget is due to simply the fact that we've got $2,000 of extra machine hours in our budget when we're using a 20,000 machine hour budgeting base. So the variable overhead is largely determined by the volume of activity, and in this case we had much less activity than we expected to have, and so we spent much less than we were expecting to spend. But this analysis, this performance analysis that we did here, indicates that a big part of the difference was due simply to the difference in the volume of activity. So these spending variances actually identify differences between what we should have been expecting, the flexible budget, and what we actually spent. So these are real spending variances. There are real differences between our budgeted amount of spending that we would have expected at 18,000 machine hours and the actual spending we did. So it eliminates the need to explain large variances due simply to the difference in the volume of activity. And that is all the questions we have for Chapter 10. And so we'll stop it there.